We think that credit markets are fairly valued right now, that current level of spreads reflects the best case scenario for a soft landing, and spreads aren't fully reflecting the range of possible negative outcomes for the economy and the markets. So what could change that? We believe the perception of a downturn could cause investors to question the low level of spreads. It would also likely bring yields down as the Fed needs to be more aggressive.
We think one of the biggest risks to the markets as we head into 2025 is going to be the political landscape, whether that be in the US, domestic policy, domestic politics, or international politics on how our new administration is going to deal with other governments around the world.
We believe one of the larger risks that we'll face is quick changes in government policy. We continue to emphasize investments that offer durable cash flows in all economic environments.
I think one of the biggest risks that we'll face in 2025 is likely to be the policy uncertainty that will come with the Trump administration. I think we could see uncertainty around inflation, around growth, and around geopolitics. I think that will be a real risk to the markets and something that they're not expecting. I think markets are priced for perfection, especially credit and equity markets, and any kind of shift in the narrative around what we're expecting will cause some volatility in the markets.
It would be easy to say that the biggest risk to markets will be geopolitical because that's always a big uncertainty. But I think really there's this underlying volatility that will be just resulting from a lot of different unknowns. And we're going to see it most likely in the Treasury space. So maybe we see a 10-year Treasury that fluctuates by 100 basis points. This will be something that month to month or day to day is going to impact returns. And so this will drive sentiment. And I just think it's going to be something that will be ongoing, especially in a data-dependent environment when we have so many policies that are unknowns.
We are facing complex risks surrounding inflation and growth. The markets are in a wait-and-see mode, waiting to see how tax cuts, tariffs, deregulations, and spending cuts shake out. Given the uncertainty surrounding inflation and growth, the Fed's terminal rates and Treasury term premium may be higher than the market expects.
We think one of the sort of downside risks to high yield that is perhaps more probable, or one that we're keeping an eye on, is a resumption in inflation. Inflation would kind of stop the Fed in its tracks, maybe boost yields. That will put more pressure on companies refinancing and the interest costs they're paying, as well as consumption and so on. So that's one of the key risks that we're focusing on.
In terms of mispriced sectors and spaces in the market, I think the market has yet to fully internalize the idea that interest rates could be higher for longer, and that impact is going to be felt over a long time across assets that really rely on interest rates. A decade of very low interest rates has created a large quantity of the economy that is used to a low cost of funds. As the higher for longer interest rate cycle becomes more internalized in the economy, we expect the resolution of those adjustments in costs of funds to occur across sectors and to create opportunities while it occurs. Large portions of the commercial real estate market, the corporate credit market, are very accustomed to very low costs of funds. And as they adjust over the course of this year and coming years, we expect that to create substantial opportunity.
I think one thing the market may be mispricing is the amount of mergers and acquisitions that could happen in 2025. With the new administration coming in, it seems to be a little bit more market friendly, and reducing regulations could allow for some larger tie-ups to happen that wouldn't have happened under the last administration. This could lead to an increase in supply and some overhangs in sectors that maybe were untouchable in the past. So this is one factor that I don't think the market is really counting on right now.
I think the biggest risk to the market in 2025 is actually going to stem from the fiscal issuance standpoint. In my view, how the Treasury opts to fund the deficit is going to be the real key and the real linchpin to the Treasury market going forward. Bessent has previously noted that he does not believe that T-bills should be the primary funding use. And so that could really only add to further coupon issuance, which will ultimately weigh on the long end of the yield curve.